So I kind of, I do not know how many of you have, come across this ruling. I know some people I've spoken to in one-on-one, who have been investing with me. I have informed them about this opportunity. Uh, but how many of you are aware of this ruling that your mutual fund investment in India can be tax-free, considering you are a tax resident of Malaysia? Anybody's aware of it? I know some of you on this meeting are aware of it, but how about the others? So I've just kind of initiated a chat. If somebody can, a poll, if you can either select the answer yes or no, that will help. I hope you're able to see the poll. If you could just select yes or no, aware of this ruling that came about sometime in April. A lot of news that was flowing out in April about this change. So yeah, it's, I think, surprising. Not many are aware of it, uh, and it's great. Okay, good. I think it's good that I'm running this session, because I spoke to a few people and there were some who were aware, some were not aware. So, but I thought there's a lot of news around it and people have heard about it. That's okay. Then let's start. I think it's 11:05. I hope to cover this in about 35 to 40 minutes max. Maybe stretch it a bit to 45 minutes. And if you have any, I'll answer the questions if you have. And you can reach out to me if you have questions, separately as well. So let me begin. uh, so this I'm going to kind of talk through the mechanics of what is required to make this happen, and it applies specifically to NRIs in Singapore and Malaysia. There are other countries also that do not have capital gains taxes, but right now the focus is on Malaysia, considering that all of you are living in Malaysia. Now, everyone would be aware that Malaysia and India have a double tax avoidance agreement, and that is what forms the foundation of this opportunity. So I'll quickly move to the next slide. So my name is Nihar. I know many of you know me. People who do not know me, I am founder of Quantum Wealth. I am based out of Malaysia. I live at the Loft. Uh, I am a certified financial planner. I have also completed my NISM for mutual funds and PMS, and I have been a financial planner for more than 10 years. And prior to founding my company, I have been an investor. I've been a consultant as a financial planner. I was also working in the corporate world 15 years in MNC roles. So this is something that was a passion for me. And eventually in 2023, I decided to take the plunge. So what services do I offer? Quickly, I prefer to take a goal-based approach. So I would like to understand my clients' financial goals. So typically, for all of us Indians, it is retirement goals. It will be children's education is a priority. It will be a house. These are three top goals of any Indian, irrespective of which part of the country do you come from. And of course, then it will be girls' marriage, children's marriage is the fourth one. So I prefer to understand your goals, determine what kind of money is required to achieve those goals, and then we work on a strategy to achieve that number. Obviously, where my income comes from, through mutual fund distribution. So I work with a platform, and I'll talk briefly about it in the subsequent slides. PMS and AIF, GIFT City funds, life and health insurance. Life is purely term cover. I always recommend that we should go for term cover. Debt port products, and also a portfolio review. Something very interesting that my partner platform has come up with, and it's an AI driven portfolio review. So any mutual fund portfolio, we can kind of sync it with our platform and have an AI run in the background and tell us how exactly it is doing. So it is something that I'll talk about later. So let me jump into the topic of today. Benefits from my session. Uh, I mean, everybody wants to save capital gains in whatever form. Though in India it is about 12.5% and 20%, but obviously it pinches when you compare it to a situation, couple of years back when there was zero. And in all likelihood, the Indian government might choose to increase capital gains taxes in the future. So obviously we want to kind of, if there's a possibility to avoid it and avoid it through a legal route, then why not take that option? And obviously to leverage this option, you need to be aware and also understand how to do it. So my session today is going to talk about the what is the ruling and the mechanics of saving capital gains. So this will give you, hopefully this will give you good insights, and you could do it on your own moving forward, or you could reach out to your own financial advisor slash mutual fund advisor to make this happen, or you could reach out to me. So you could leverage any of these options. So the background to this case, a Singapore-based NRI earned about 1.35 crores in capital gains. This was long and short, and in equity and debt mutual funds. This case was sometime in financial year 22-23. Now, obviously, being an NRI, the tax is deducted at source by the mutual fund, and the remaining money is then transferred to the investor's account. This was a smart investor who was aware of this, and they decided to contest this tax. So they contested this tax levy, citing Article 13 in the direct tax avoidance, double tax avoidance agreement between India and Singapore. So obviously, the income tax authorities, absolutely did not agree to it. They kind of pushed back, and what they realized, so these guys went forward. They were not somebody who were going to let it go. So they moved ahead with disputing it, and finally the income tax tribunal at that level, it was decided that the investor had a valid reason or valid argument, and hence this tax is not applicable, and obviously the money was refunded. Now the technicalities involved was, in this refund was that in the context of mutual funds, they are treated as trust and not as companies. So when we invest in a mutual fund, we are actually investing into a trust. How many of you are aware that mutual funds are actually trusts? They are not companies. They may be owned by, say, like a Kotak mutual fund. So the owner is Kotak, the Kotak bank, but a separate company that is formed is actually a trust. It's not the company. It's not a company in terms of defining its registration. Similarly, even ICICI Mutual Fund, it's a separate entity owned by ICICI Bank, but it's a separate entity and it's a trust. So anything that is invested through a trust does not entail capital gains tax, and that's where the investor had a valid argument and won the case, and then it pretty much now becomes applicable to NRIs in countries where this specific clause is inserted in the agreement between India, say in this example, India and Malaysia. And I'll show you in the subsequent slide, what exactly is this wording. So obviously, mutual funds, though investing in shares, are not classified as shares under DTAA. And in the Article 13 of the India-Singapore DTA, mutual funds are not explicitly covered, and as per this article, capital gains are only taxable in Singapore, in the country of residence. In this case, Singapore. When it comes to Malaysia, for us, it applies to somebody who is living in Malaysia, and the taxation right remains with the resident country, either Singapore or Malaysia. Now, because of this ruling, the investor would have saved close to 20 to 30 lakhs, because assuming that somebody had a 12.5%, if everything was long term, then a 12.5 would translate into about 15 to 18 lakhs. If it was short term, it would translate to about 27, 28 lakhs. So it's not a small sum of money, considering that most of you would be investing via SIP for the long term, and at some point, and I'll show you the math, the numbers could turn out to be in crores when you're investing. So I will take a pause. If you could, if anybody has a question, if you would want to ask a question, raise your hands, either ask a question or put it on a chat. I'll be happy to answer here. Okay, going one, going two, going three. Okay, if there are no questions, I'll move on. And do let me know if the pace is fine. If it's fast, then I can slow down. I know I tend to talk fast at times, so happy to kind of correct myself. So moving forward, now what are the implications? So the implications are very crystal clear, from what I just said. Tax-free capital gains, so zero tax, net. And the good part is applies to short and long-term capital gains, and it covers debt and equity mutual funds. So really, as an NRI investing from Malaysia, as long as you're investing in mutual funds, you are not going to pay taxes at all. So there is complete flexibility of exiting fund without having to worry about taxes. I've spoken this, and there are a few people on this call. I've been talking to them about switching funds, and if there are switching funds, so if you're switching funds, also there are no taxes. So there's a question by Yogesh. So I'll take that question now. So Yogesh, yes, if there is so I have a criteria, later on that I have put down, that obviously this will go for contesting. The income tax tribunal is not going to let it go. They will, or the income tax authorities will definitely take this up with High Court. They will go to Supreme Court, and possibly there could be a reversal. But if you look at technically, the language clearly articulates that mutual fund is treated as being a trust is not taxable. So unless they change the wordings, I don't see. There is a chance that the government or the court may not agree with income tax authorities. But to be sure, to ensure that you do not end up spending the money, it would be a good idea that whenever you withdraw, you determine what is possibly going to be your tax implication, and you could park that money in a debt fund, or you could park it in a more conservative fund. So because if ever that money has to be returned, the money is at least parked somewhere, and where it can be pulled out easily and without the volatility of an equity fund. So depending on what kind of money you're pulling out, what amount you're pulling out, and are you able to kind of, if at all at some point, if the case reverses and if you have to pay back, if you're able to pay off, from your regular income or from one of your other funds, then it's fine. Otherwise, park it in a debt fund. So I hope I've answered the question. And also, yes, made the point that it can potentially be reversed, but currently it's a 50-50. So countries that are that benefit from DTAA is Malaysia, Singapore. There's a whole host of countries. What we did was, I have that slide later on. A fund house has listed down some of the top countries from where maximum remittances come into India, and Malaysia is one of them. So they have said these if there are investors coming from these countries, then whether it's applicable, not applicable. For example, US, UK, Australia, Hong Kong, Canada. Sorry, Hong Kong is written twice. From here, if you're investing, then obviously this agreement. I mean, you do not have this benefit of taxes. You will have to pay tax. So the best part of Malaysia is that Malaysia has zero capital gains. So effectively, you don't pay any tax at all. And this applies to capital gains on just about anything. There is no taxes. So I think this is one of the biggest benefits of being in Malaysia. You could invest in the US market, you could invest in the Indian market, and end up not, and also in the Malaysia market, you end up not paying any taxes on capital gains. Now I'm going to walk you through the steps to be taken to claim DTA benefits. The first and the most critical is going to be the tax residency certificate. So you can seek a tax residency certificate from LHDN in Malaysia. I will share a link on the chat, so you could pick up that link and go through it and apply for the tax residency certificate. It's an online process, doesn't require any physical intervention. There might be one requirement where they may ask for your passport details and your in-out details from the immigration. So that's something that you will have to organize for. I see that because I haven't actually done it because this came just about in April. I did not have anyone, who was taking money out. I myself have not taken out money from mutual funds in the last 6-7 months. So there was no ways for us to validate. But once I validate it, I'll kind of keep the group, posted about, what exactly are the mechanics. But right now, you need a tax residency certificate. You will need an immigration in-out. So that is something that, we can pick up from the immigration department with an application. And when you're redeeming, so there are two ways you could do it. One is when you're redeeming, so before redemption you could do it, or you could just do it as a process. Get a TRC from Malaysia. You get a form 10F from the Indian IT department. So fill up the form 10F. It's a very simple form. Include a self-declaration letter, to the mutual funds houses or CAMs and CAWI, saying that you are a tax resident of Malaysia and you are enclosing the TRC and form 10F for their reference. And these documents can be sent across to the RTAs, which will be either CAMs or CAWI, and they will, in their record, update you as a NRI in Malaysia. So once that gets recorded, then for all practical purposes, any redemptions that you make from there on should be tax-free. But keep in mind that what I expect it to be challenges, that they could possibly ask you that, because they'll ask you for a TRC for the calendar year. So for example, in calendar year 2025, you are Malaysia tax resident and you apply for a redemption, say in April 2026. The RTA may reject it, saying that this is proof for 2025, we need proof for 2026. And that's when you may not get the exemption at the point of redemption, but you can claim it when you file your returns in 2027. And another thing to keep in mind is that the tax, sorry, I'll just kind of come to that at a later point, because the tax years in India and Malaysia are different. So there is some technicality over there as well. Now, as I said, if the income tax is deducted, then you can claim a refund when you're filing your ITR, which is a mandate. I mean, if you have a PAN card, you have to file income tax returns in India, whether you earn any income, you don't earn any income. I have seen a lot of NRIs who just stop filing returns, and this could be for years together. So, which is not a great idea. So, I would recommend, if you have not been filing returns, you should start to file returns in India, and you could leverage. I mean, take help of a chartered accountant. They charge hardly 3 to 5,000 rupees annually to file the returns, depending on what amount of money is involved. But typically, even high transaction value, not more than 5 to 10,000 rupees. Now, the most critical piece in this is, you'll have to pass the principal purpose test. That is that you're not living in Dubai or in India just to avoid taxes in India. So, sorry, I meant either Dubai, Malaysia, or any other country in the world. You're not living just to avoid taxes. You should have a valid reason to live, uh, and not just so that you show your residency in that country without any reason, or in the sense without any income or without any job, and you just to avoid taxes, paying back taxes in India. So if you're able to kind of get these five points together, then it's going to be easy to start claiming tax benefits when you make any redemptions. Now, key takeaway for NRIs. Before I get there, any questions, on the last slide? Okay, I'll anyways, answer questions later on. So you could keep it for the later point as well. So now key takeaways is, yeah, again, it does not apply to direct stock investments. So, if you either are directly investing in stocks, or if you're investing through a PMS in India, then you do not have this benefit. As I said, mutual funds could still deduct taxes even if you have submitted the documents. We'll have to keep ourselves, abreast with the DTA clause. It's something that I'm tracking. So whenever, if I come across some changes, then I will keep at least people who have joined in. I know in my circle, I will keep them posted. Again, stressing the fact that you've got to be a bona fide tax resident, not living just to avoid taxes. As I said, tax and treaties may change, so we've got to be informed, stay informed. Documentation is going to be critical on an ongoing basis, as I said, because what I expect the Indian IT authorities to do is they'll say that every year you have to prove. So if you've proved in 2024 that you are a tax resident of Malaysia and you withdraw in 2025, they'll most likely ask you to prove again you're a tax resident in 2025. They'll ask you to prove that again in 2026 you're a tax resident. So this is not going to be like a one-time thing that you submit these documents, you submit your TRC, Form 10F, and you're done and dusted. No, it's not going to be that way, because your tax residency can change every year. The IT department is probably going to insist that you prove it every year that you're a tax resident when you do a redemption. So just ensure, if somebody is traveling too much in and out of Malaysia, especially to India, just ensure that you're kind of complying with the requirements of residency in Malaysia. And I can say that because I spend a considerable amount of time between India and Malaysia, so I've got to kind of at all points I'm doing the math on the days in India versus the days in Malaysia to maintain my NRI status. Yeah, as somebody called out, the Indian IT department may appeal this ruling. No update as yet on this. So as I said, excess refunds, or basically your profits could be taxed. So it would be a good idea to determine what is that tax amount and park it in a debt fund. Or you could put it in an equity fund, but don't use it. Basically, don't use that money for something. Keep it aside. As I said, the assessment years in India and Malaysia are different. Malaysia follows the calendar year, which is Jan to December. India follows April to March. So, you'll have to be aware ensure that you keep this in mind. And if you have a CA, please consult a CA or a tax consultant, before you're redeeming, or you keep a track of this math yourself. Obviously, you have to be an NRI to take the tax exemption benefit, an NRI in Malaysia. So I'm just giving a simple math, the potential savings of taxes, and I'm kind of showing this, as a so okay. Before I go to this, Yogesh is asking dependent pass holders. Yes, because Yogesh, technically even a dependent pass holder is a NRI because they're residing out of India. So they can claim this benefit. But the most critical piece, is that I have seen people, the investors themselves, the main, the gentlemen in the house, many of them don't convert their status to NRI, or they don't change their bank accounts to NRE, NRO. They still do most of the savings investments through savings account. And there are people who have been here for 10 years, 15 years, still do that. The other issue is that the person who is, the men who are earning in Malaysia, because they change their own PAN, but the dependent is still showing up as a resident. They don't change their dependent's NRI status or their PAN status to NRI. So if you don't show that change, there's no ways you can make that claim. So I hope I answered the question. So I'm just showing this math on saving for SIP, because I typically recommend people invest long term, invest for a SIP. So I'm taking a simple example. If somebody is doing a monthly SIP of 1 lakh for 10 years, so the invested amount is 1.2 CR, because 1 lakh a month, that means in a year it's about 12 lakhs. You multiply by 10 years, you're investing about 1.2 CR. I'm taking a very conservative return of 12%. So on a conservative return of 12%, this will be approximately 2.25 to 2.3 CR will be the corpus at the end of 10 years, which means that your investment is 1.2, your capital gains, your profit that you're sitting on, your notional profit is 1.05 crores. Now, if you have to take this out completely, and assuming that it's a long-term capital gains on most of it, you'll end up paying about 13.12 lakhs in today's tax structure. Now, with this benefit, you're effectively saving this 13 lakhs, and this could be rolling. So for somebody who starts now, it's 10 years down the line, but of course, we do not know how the tax laws will be then. But if someone who has been here for 10, 15 years and have been saving, investing regularly, you're effectively sitting on a 13.12 lakh, saving as we look at it right now. So over a period of time, there's going to be a significant savings on this front. Now, how to execute? I've already kind of outlined, what are things that we need to do for investors continuing to live in Malaysia. Apply your TRC Form 10F and submit it to the either CAMS and KAVI, either at withdrawal point or after you've completed withdrawal. I'll share this link, from where you can get your TRC. And another point, is for investors who are returning to India for good. You could leverage this by exiting. For example, if someone knows they're going to go back to India, and this is for planned. If somebody is just making a very short term, if somebody makes a decision instantly, this may or may not apply. But if somebody is planning their return back to India, say 1 year down the line, I'm going to go back to India in 2026, 2027. Then what you could possibly do is, you ensure that you are a tax resident of Malaysia. you get your Form 10F, and then you exit your portfolio completely. So what happens is your entire portfolio is redeemed while you are a tax resident of Malaysia. So effectively, you don't have to pay any capital gains on your profits on this portfolio. And you could reinvest this money. Technically, you can reinvest it the next day, because then the clock will start all over again. So if you invested in a mutual fund unit at 100, which is now worth 200, that 100 to 200 difference is going to be completely tax free. And you reinvest it again, say technically on the 5th day or 10th day, 15th day, and then you invested at 201. Now that is what will be your starting point when you go back to India, and when you take a redemption and say assuming the amount then is 300, then effectively your tax liability is 300 minus 200, which is 100. But if you had not made this, if you had not affected this withdrawal, it would have been 300 minus 100, which is 200. So you're kind of reducing your, in this example, you're reducing your tax liability, your profit to just 200 rupees versus 200 rupees. So it is something that you could, be plan in advance, think through it, and probably, prepare for it. As and when time comes, you can affect this change. So I have a question. So I'll just kind of, if anybody has question on this specific slide, then, do drop me a message. And in the meanwhile, I'm taking a question from Yogesh. So Yogesh's question is that the mutual fund houses have asked for a tax residency certificate, for an NRI, for a tax identification number. Otherwise, to get tax benefit, otherwise they'll be termed as residents in India. Yogesh, I don't have an answer for this. Technically, that is not needed, because if the person is not earning, does not mean that the person is not a NRI. But I can check and come back to you. So I'll take this as something, to get back to you. Any questions on, specifically the second point? Because, or you could reach out separately, and I could explain what could be done. I'm assuming if people, are not clear about it. Okay, I'll move on to the next slide. So, yeah, this is some a good input from Quantum Mutual Fund. They have kind of put taxability of, they have kind of clearly outlined this in one of the presentations. So taxability of mutual fund capital gains under double tax avoidance agreement. And if you see the last at the bottom is Malaysia. The assessment is not taxable in India. And specifically, if you see the agreement, the tax treaty capital gain comes under Article 14 into bracket 6 of the tax treaty. So this is the point cited in applying this for NRIs living in Malaysia. Do let me know if there are any questions on this specific point. If not, then I'll move on. Yeah. So, yeah, so summary and recommendations, that's a zero capital gains. So it's a decent saving, 12.5% for long term and 20%, for short term. You've got to get your TRC and update Form 10F. You've got to time your exits carefully so that your calendar year, financial year balances out. If you're continuously living in Malaysia and always a tax resident, then you won't have an issue. It's just that the amount will get deducted and you'll have to claim a refund when you're filing your return. So that could be the only thing. But if you are traveling too much, and then you've got to be mindful. Consult tax advisors, though I know a lot of tax advisors may not be very much familiar with this, uh, unless they're doing NRI specifically. And if there is any change in rule, you've got to stay updated. It's kind of a lot of updates come on social media. I myself track it because it applies to me, applies to my client. So if there's a change, I will keep people posted. So yeah, so with this, I have kind of completed this. I've covered this specifically on capital gains. I'm I'm talking a bit about now about I partner with a firm called Wealthy. So just to give a perspective, as I said, I'm a mutual. I do financial planning and I help clients invest in India. So invest in mutual funds, PMS, etc. And for this, I partner with a platform called Wealthy. It's a technology platform, giving a bit of a perspective. It's a fully digital uh, platform. So it works through an app, just like a Zerota or a Grow. But the only advantage is that they don't go direct to consumers. They work with it's business to business. So typically, I, as a financial advisor, independent financial advisor, leverage their platform, and the benefit brings is that they bring in like a 350 plus in-house team. It's an award-winning platform, about 5,000 plus financial advisors on this, more than 5 to 7,000 crores of AUM. They have got all their licenses in place, that is SEBI, AMFI, and IRDI. Just recently, they went through a second round of funding of about $14.5 million. This just came about earlier this week. This was the news. So a phenomenal team. So which and hence this I decided to partner with them. So the entire customer journey, so as an investor, or rather investor journey, is fully digital. There is no paperwork involved at all. If you have to do your KYC as an NRI, that also is done digitally. You've got to just upload the documents or send it to me, and we'll process it for you. But absolutely no physical process is required at all. And of course, another thing that they're doing is they're putting a lot of effort on AI engines, to kind of help both the investors and the partners. So one thing that they've come up with is, an AI uh, tool to assess your mutual fund portfolio. So your investments can be run through, if you kind of onboard on the platform and sync your portfolio, your existing mutual fund portfolio, then we can run it through AI, and we'll have a report out for you to tell you exactly how the funds are doing, and with recommendations. So feel free to kind of scan this, or you could drop me a message separately, and I'll get you onboarded. Otherwise, you can use the scan to at least onboard yourself. Put down your details, and then we'll take it up from there. So yeah, so that brings me to the end this uh, of this meeting. Is there anything that you want to ask me? I'll be happy to answer, or we could take this offline. You could drop me a note. So before that, parallelly, I'm kind of putting in a poll. If you could take that answer, that will help. Again, I'm just stressing, this is